The ETF industry has been in the business of disrupting and improving investor outcomes for the past 30 years. ETF issuers, the product providers, sit in the front line of this innovation. Here we get to hear their stories and learn what it takes to be a disruptor. This is ETF Wavemakers. Welcome to Wavemakers. I am Cinthia Murphy, Head of Research for the ETF think tank. And today I'm joined by Alex Shahidi, who is co-CIO and managing partner at Evoke Advisors. Hi, Alex.
Hi, thanks for having me.
I'm excited to talk to you today because I think you have a really interesting journey in the industry. So you were, at Merrill Lynch working with institutional clients. And then in 2014, you started a firm called Eris, which in 2020 merged with Evoke Advisors. So I'd love to explore that journey a little bit. So, let's start with you're sitting there at Merrill and you have this idea to start a new business. What was the opportunity you saw or the problem you were trying to solve that led you to create Eris?
Yeah, it's a great question. So I was at Merrill Lynch for 15 years, and I'd say after the first year or so, I kind of discovered that our industry is more of a sales industry, not really an investment industry. And I'm not a salesperson at all. Anybody who knows me knows that's one of the things that I'm definitely not. And I think of myself more as an analyst. And I feel that my responsibility is to give the best investment advice to clients. And I feel like that's what all advisors should be doing. It doesn't help the clients if you're a good salesperson. So early on, I realized that I wasn't maybe exactly the right fit for that industry because I was so different from most people. And so I called myself an RIA trapped within a brokerage firm. That's kind of how I felt, not in a bad way, but that's just how I started. And for 15 years, I operated under that setup. But what worked well is I was able to effectively operate like an RIA within a brokerage firm. So when I was there, I hardly used Merrill Lynch as a custodian. I didn't use their research. I didn't use their products. I just happened to work there, and my office was there, and my staff was there. But I wasn't a typical Merrill Lynch financial advisor. So for years, clients were asking me, well, why are you even at Merrill Lynch? You're not really using anything that they offer. And I would tell them, well, look, I'm an independent, objective advisor. I look at everything they offer. I look at everything else that's out there. And my job is to find what's best available to you, knowing what I know about our industry. And most of it's not at my firm. So I'm going to give you what I think is best. So it was very natural to transition from that to launching my own RIA 15 years later. I probably could have done it 5 or 10 years sooner, but I just felt like that was the right time. And one of the reasons I felt it was the right time is because even though I had a lot of flexibility while I was there, the firm was great. I was managing over $10 billion. And so it affords you some flexibility. I still couldn't do everything that I thought I needed to do to serve my clients well. And so when I left, then we started becoming more creative and being more innovative, where you can actually create structures that I call it structural alpha. People try to generate alpha, excess returns by timing markets. It's hard to do. Trying to do it by creating structures, it's a lot easier to do it, much more reliable. And you can't really do that under the umbrella of Merrill Lynch or big firms like that. You really need to be on your own. And obviously creating an ETF is one of those, structures. So that's why I left. I had my own firm for 6 years and then merged it with my good friends at Evoke Advisors, who I'd known for 20 years. And we talked about merging our groups for probably since 2007. So it took 13 years until the stars aligned and the timing was right for us to join forces. And so now we're about 23 billion, about 60 people, for about 650 clients or so.
Yeah, and it's a firm that it's been recognized by the industry in terms of success. I think in the last year, it's landed in the the 50 IRAs to watch list. It's a firm that's being recognized. So congratulations on that.
Thank
But
you.
what I love about
We were lucky. Forbes ranked us #1 last year, RA in the country. So that was nice to see.
impressive. Yeah, which is not a small feat because there's a lot of advisors out there. But what I think is so cool is, one of the things that weigh a little heavily on the industry is the sales culture, to your point. So I think it's fascinating that this recognition that one, that wasn't to the benefit of the client, beyond the fact that it just wasn't you to begin with. So I think it's kind of an interesting step towards client service and the fiduciary role and all of that, those things that we value in the advisory space. Is that a key part of Evoke's value prop? How do you define Evoke Advisors value
Yeah.
prop today?
Yeah, it is. Let me just start by saying it's understandable why the industry is set up that way. I don't think it's anything that is, an ill intent of the advisors or the industry. I think it's just set up that way because one of the hardest things to do as a financial advisor or a financial advisory firm is get clients, because you have to go and convince people to give you their hard-earned money. That's not easy to do. And so it takes good sales skills in order to survive, to basically have clients. You could be the greatest investor in the world. If you don't have good sales skills, it's going to be hard to convince somebody that you're a great investor. So what ends up happening is there's a natural screening process where great salespeople survive, and those who are not great don't survive in general. Obviously, there's exceptions. And then the other thing that's very unique about our industry, and I don't know if there's another industry like it, where you could have somebody who's a mediocre investor could look brilliant for a long period of time, and somebody who's a great investor may look like an idiot for a long period of time, because there's a lot of randomness in market returns. And so it's really hard to decipher who's good and who's not good. And as a result, the sales skills tend to dominate. And so you end up with a lot of salespeople in the industry. And what's interesting, and I say when I first kind of discovered this early on, I said, this is not sustainable. At some point, the clients are going to learn, who's a good investor and who's not. And I want a good investor as my advisor. And the industry would naturally evolve to a point of just having good investors. It's difficult because it's hard to decipher who's good and who's not. And number two, the advisors only need to know a little bit more than their clients in order for them to maintain those clients. And the clients have a hard time seeing the difference between somebody who knows a little bit more than them and somebody who knows a lot more than them, because the industry is hard to decipher. And so you end up with a lot of clients working with advisors who know a little bit more than them. And the more sophisticated advisors may have more sophisticated clients, and the less sophisticated ones have less sophisticated clients. But there's a lot of clients. And so it's a massive industry. And it persists that way because just the way it's set up. So we understand that. And yet we know that's not the right thing. Clients deserve better advice. And so we position ourselves as analysts and as advisors. We obviously have some sales skills. We wouldn't have 23 billion if we didn't, but we try to attract talent that is a really good investment consultant. We spend a lot of time doing research. We try to talk to the smartest investors in the world. Having large assets gives you access to the brightest minds on Wall Street. And that's the culture that we're trying to develop, is a place where we want to attract talent that wants to work at a place that's focused more on investing than on sales. And hopefully we'll attract clients in the same way. So I think that's really the value proposition.
So what's interesting about that, and I don't think this may be a silly question, but if you're out there and you're trying to figure out, do I have a good advisor or a bad advisor, right? So to make that distinction, is that a time frame thing? Because to your point about good investors can look bad for a long time. I mean, we've seen that with value investors, right? They've looked bad for a long time, and then all of a sudden they were geniuses. That's where we get the whole concept of the recency bias and all of these things that impact how we perceive success of our portfolios. So is there, in your experience, a good way to make sure you are working with a good investor? Or is it, to your point, just about research, just about content and education? How do you cut through the noise as the advisor?
Yeah, it's a really good question. The way I think about it is what's the role of an investment advisor? Obviously, they're there to hold your hand, walk you through the process. But in terms of building a portfolio, what I feel like our responsibility is to manage risk. It's if you can get a comparable return as others, taking a lot less risk, that's a better portfolio than one that takes more risk. And risk is a hard thing to see. You see it during really bad environments, but during most environments, you don't see it. It's like that old saying where, everybody's a good pilot until there's a storm. And when there's a storm, you can see who is a really good pilot and who isn't. And so the way I think you can quickly tell whether your advisor is doing a good job managing risk is you can just take a snapshot of your portfolio. And like most portfolios, they're heavily concentrated in stocks. That's not a well-diversified portfolio. And as a result, you're probably taking too much risk for the return that you're seeking. And if your portfolio is much more diversified, and one way to say that is less stocks, more other things that have equity-like expected returns, but are different from stocks, that's a more diversified portfolio. That's just the simple math. And that portfolio is probably better positioned long-term than one that is heavily concentrated in stocks, because that stock-heavy portfolio is going to ride the ups and downs of the stock market. And if you just look at history, and I'm saying go back 100 years, the stock market goes through long-term bull markets, long-term bear markets. And during the bull markets, it does exceptionally well. During the bear markets, it does terrible. And if you're on that ride, you're going to be thrilled for it's about half the time and really upset half the time. And we've been in a 13-year bull market, maybe 14 years, since the lows of 2009, basically straight up. COVID went down for a quarter and bounced right back. And most people are stock heavy, so they're happy with their portfolio. But you don't, looking forward, you don't get the same returns you earned looking backwards. Oftentimes it's the opposite. And so just a simple glance of your portfolio, if you have more than, let's say, 40 or 50% of stocks, you're starting to become heavily concentrated, and that's just a lot of risk.
So this is it's kind of the premise of some of your work in the book circuit. I mean, you're a prolific writer, and you have two books that I could find: Balanced Asset Allocation and the Risk Parity book. So let's walk through that thinking. I think it's interesting. Like, we currently live in this era of it's all about managing risk. I think the whole post-pandemic market has made people realize that correlations can be a real problem, that risk appetite can quickly turn sour. And so share with us here, Alex, how you think about the stuff that led you to write two books about it. One about just the concept of the 60-40 and the high correlation to risk that you can get there, and the idea of risk parity as an all-weather type of allocation.
Yeah, the way to think about it is just forget everything you know about investing and just start with kind of the basic principles. The way you can earn an attractive return through time with the least amount of risk is you invest across individual return streams. Think of all of these as streams of returns that are individually attractive, but different from one another. And what I mean by different is they're fundamentally biased to do well and poorly in different environments. And if you can do that well, that's a more diversified portfolio than one that is heavily concentrated in a single asset class. So if you just think about a conventional 60-40 portfolio, if you think about the framework most people use to build a portfolio, they basically have two assets to choose from. It's high return, high risk stocks, low return, low risk bonds. And they go, from, mostly bonds to mostly stocks, depending on how much risk and return they seek. And so that framework has a significant flaw, which is the more risk or the more return you're trying to achieve, the more concentrated the portfolio becomes. In other words, the less diversified it becomes. There's a trade-off between return and diversification. So we all know that the one free lunch in investing is diversification. If you're more diversified, you get a higher return for the amount of risk you're taking. That's just the math. But if there's a trade-off between I want more return and I have to become more concentrated, less diversified, that's not a good trade-off. So the question is there a better framework than that? And fortunately there is. And it follows the concept that I started with, which is individual return streams that are attractive but different from one another. And so rather than just betting on one asset to give you that high return stocks, you can invest in multiple assets. Some of them are more understandable. Others might be a little bit surprising. So let me just go through the four that we use that I think have been around a long time, and can achieve equity-like returns, but are different from one another. So obviously equities, you can just buy the index and get equity-like returns. Commodities are another asset class that are diverse to equities because they're a better inflation hedge. Think about the 1970s, stocks underperformed cash. Equities or commodities did really well. So for commodities, instead of buying commodity futures, you can own commodity producer equities. These are the companies that pull the commodities out of the ground. So their returns are heavily influenced by the price of the commodities. So for example, last year, an index of those companies was up, 10 or 15%. The stock market was down, 15 to 20%. Big difference. And then gold is another one. Gold is more of a currency and a storehold of wealth. You add commodity equities and gold, and that basket over time has an equity-like expected return, but is different from equities. So instead of just having, global stocks, you have those two, and that is more diverse. You're already making headway into building more diversified portfolio. The other two assets, this is probably more controversial, less well understood, is treasuries and tips. So these are, government guaranteed bonds, no credit risk. It's basically interest rate risk. With treasuries, you have inflation risk. With tips, you don't have inflation risk. Those two assets are normally viewed as low risk, low return, but they have a similar Sharpe ratio or return per unit of risk as equities, roughly. And so all you have to do is raise the risk of those assets, and you have a similar expected return. And there's two levers you can pull to do that: longer duration, a little bit of leverage. And if you do that over the long run, you can actually expect a comparable return on risk as equities, but it's diverse to equities. So you take all that and you put it in a single portfolio, and now you can get an equity-like return over time with risk that is much less than equities and more like 60-40 risk. So that's the framework for balanced asset allocation and risk parity, the two books that I wrote. You can think of it as an all-weather type of portfolio. It's passive. It doesn't assume any timing abilities. This is just buy and hold over the long run. It's a more stable ride than an equity portfolio with the same expected return. And it's because it's just much more diversified, and it's the diversification that you're betting on, not much else.
So what I think is interesting is that this investment philosophy or way to approach portfolio construction, to go back to where we started, when you're talking about structural alpha, you offer two ETFs, RPAR and UPAR, which capture this way of thinking. So let's talk a little bit about the choice of the ETF vehicle as the way to deliver the access to your way of thinking. How did you make that decision? Why ETFs in the first place versus anything else? How did you get to ETFs in the first place?
It's really interesting because to me, there's two separate steps. There is, first, what portfolio are you trying to construct? And then the second is, how do you structure it? So the structuring part is the ETF question, but let me cover the first part. If you think about the way most people invest, they have, a portfolio of stocks and bonds. And I feel that if you have a more diversified portfolio, you can be in a better, place in risk and return space. And if you just think about as a goal for your portfolio, the things that you can be confident benefit you over time is high diversification, low fees, low taxes. Okay. Trying to time markets, you'll be right sometimes, wrong sometimes. On average, you're probably about even. That's a hard thing to depend on in terms of building a portfolio and what you're seeking to achieve with that. But high diversification, low fees, low taxes, those are beneficial over time. So I think from an objective standpoint, investors should try to emphasize that. And what's interesting, if you look at what's out there in general, this is my experience, most portfolios are have low diversification, high fees, high taxes. Okay. And so the diversification is low because it's more 60-40 based. And I described why that's not that well diversified. 60-40 portfolios over 95% correlated to 100% stock portfolio. That statistic surprises a lot of people. And it's because you have more allocated to the volatile asset stocks. So the stock return dominates the total return. And as a result, is highly correlated. That can't be diversified. Anything that is 90+% correlated to the stock market is not a diversified portfolio. So most portfolios have low diversification. They generally have high fees because there's active management, the advisor tax on a fee, and that there's multiple layers of expenses. So fees are high and taxes are higher than they should be because portfolios are more actively managed, because people are trying to generate alpha by timing markets. And so what I feel people should do is maximize diversification, minimize fees, minimize taxes. Okay, so that's, I think, the objective. And I think over time that benefits investors. So how do you implement that in practice? So that gets us to how do you structure that? So when we look at diversification, it's this risk parity framework. You don't have to do it exactly the way we do it, but the framework of diverse asset classes, to me, makes a lot of sense. So that's a diversification box that you can check. So how do you minimize fees and taxes? You can look at all the different structures available. ETFs, in my opinion, are the best because it has this very unique tax minimization structure that is unique to any investment structure. And then it's also, they generally are low fees. So basically, if you can take a well-diversified portfolio, put it inside of an ETF, then you check off all three boxes. You high diversification, low fees, low taxes. So that's what led us from discovering this approach to investing, which I've been using with my clients for over 15 years, and to create a more efficient, tax efficient, and fee efficient structure. We looked at everything available and ended up with an ETF. And to me, that was just a very easy call.
Yeah, it's interesting because if you really think hard about it, in theory, cost is the only thing you can truly control in your investments. Taxes, with the choice of an ETF, you're kind of taking control of it too. And diversification is a decision you make. So everything else you can't control. You can't control market performance, returns, the opportunity set. So it's kind of an interesting thing how ETFs capture the things you can actually control and do better long term.
And the ETF structure, I feel, is heavily underutilized, because if you look at the vast majority of ETFs, they're either a stock ETF or a bond ETF. There are very few ETFs that are total portfolio ETFs. Now, it doesn't have to represent your total portfolio, but you have multiple asset classes inside of a single vehicle. Now you can rebalance across those. And if you do it well, you could potentially defer cap gains until you sell the ETF. That's a huge advantage. Like, if you think about it, if you're an investor and you have a total portfolio, if you could put an ETF wrapper around the entire portfolio, you would take that in a second. You just gain all these tax efficiencies that come with an ETF, yet it's heavily underutilized in the ETF industry. And I understand why, because it's hard to get your mind around, do I want all these assets inside of one vehicle? When I look at one vehicle, it doesn't look diversified. It looks like I have all my eggs in one basket. It's one security. I just see one line item. You don't really see everything inside of it. Our par, for example, has 13,000 securities. If you remove the ETF wrapper and you remove the wrapper of the ETFs inside of it, and you list every security, you have a statement that was 500 pages long, and you look at it and say, wow, I have a really well-diversified portfolio. Yet that is worse than having all of it inside of a single security because of the tax advantages. And also there's implementation, efficiencies and fee efficiencies and so on. So I think optically there's a hurdle to overcome. But if you just do the math and you understand the analysis, it's so much more efficient to be in a single vehicle. It's also easier to manage.
Yeah, it's interesting because it's like, we're preaching don't have all your eggs in one basket. And then at the same time, we're saying just own a single ticker that has all the eggs in that basket. So I think intuitively this is a hard thing to wrap your brain around. But I also wonder if, we haven't really explored a multi-asset opportunity within the ETF wrapper, because in the advisory channel, it becomes, to your point of, how do you show value a lot of times? If you're just gonna, have a conversation with a client and all you got to talk about is a single ticker, I think advisors get nervous about how do you show value with such a simple portfolio.
That's right. Yeah. So that's the challenge. Is on paper, it makes sense to put an ETF wrapper around your total portfolio. In practice, it's less practical because of the challenges that you just described. So it seems kind of the optimal place to lie is somewhere in between, where you put an ETF wrapper around a bunch of different asset classes, and then you complement the rest of your portfolio. Even if you own the same asset classes outside, it's practically easier to hold on to that. And so you kind of get the best of both worlds. It's not optimal on paper, but it may be optimal in practice. And one of the things that I've learned being in this business for 24 years is what is optimal in practice is optimal in real life, because you could have the best portfolio, and if clients can't hold on to it and advisors can't hold on to it, then you don't get the returns that you see in when you look backwards or you see on paper. What they get is what they can actually hold on to. So a lot of our job as advisors is to optimize for what's best on paper and what's best in practice, and finding the middle ground where you kind of have the best portfolio that the clients can hold on to. And so that's why we spend a lot of time educating. I spend most of my time just talking about, here's why we're doing it this way. Does that make sense? What questions do you have? And kind of testing advisors and clients as far as their understanding, and then from that determining what's the right allocation.
So when you think about, the ETF space as a provider and as an advisor, is that the toughest part of the job? Is this reconciling the behavior, our need for complexity to feel like we're doing everything we can, versus the math of the simplicity works best? I mean, what is the toughest part here? And on the other side, what is the most rewarding part, in your opinion, of being in this business?
Yeah, it's challenging because the analyst in me wants to do what is best in terms of just the math and understanding the concepts. But there's a practical side as well. So they're like competing forces. And I think understanding the concepts, to me, that's the easy part. And building a well-diversified portfolio, to me, that's the easy part. Now you have to have that knowledge and expertise to get there. So I don't want to, suggest that it's easy. For me, it's easy because that's all I've focused on for 20 plus years. The harder part is what you just said, which is communicating that in a way that's easy to understand, helping people connect the dots, trying to read people in terms of how will they respond in different environments. Some of that you just have to. That comes from experience. It comes from collecting clues about how they respond to different environments. And you have to think about the worst periods when the more diversified portfolio underperforms a less diversified portfolio, which is the reference point for most people. When you ask somebody, how's the market doing? They'll quote the Dow or the S&P because that's what they view as the market. If somebody asks me how the market's doing, I don't say, oh, the S&P is up. I say, well, stocks are doing well. Commodities are doing okay. Treasury markets down a little bit. Tips are trailing. To me, that's the market. It's a diversified mix of markets, not a single market. But that's not convention. So I have to have an understanding of how tied are you, Mr. Client or Mrs. Client, to the stock market, and is that how you judge success? And what's your time frame? If it's a shorter time frame, then your portfolio should be more market-like because you'll have a harder time holding on. So that's, to me, is definitely the more challenging part. You're in some ways playing psychologist as opposed to analyst, and constructing a well-diversified portfolio.
Yeah, recognizing that success isn't universal. Everybody has their own definition and therefore their own targets. So that's really interesting.
That's right.
Given your approach, no, go ahead.
I'm sorry. I was just going to say, it really comes down to what your reference point is. So as an investor, how do you determine success? Is success hitting your return target? So maybe you need 6% a year to meet your financial objectives. Is that your target, or is it you want to keep up with the markets? The challenge is for most people, their target changes all the time. When the markets are down, they want their 6%. When the markets are up, they want to keep up with the markets. And so there's a lot of flip-flopping, and that's really difficult to achieve. So a lot of it is trying to reinforce what is your real objective and keep repeating that. Okay, here's where we are relative to your objective. The stock market is up, you have stocks. It's not all your portfolio, it's a smaller part of your portfolio. Stock market's down, you're outperforming, and here's why. And it's just this constant process. So it's education, it's hand-holding, it's understanding people, learning how they think, what is their reference point. It's actually pretty complex, but it is necessary as far as being successful, from our perspective, because the client success equals our success, and as you mentioned, people define that differently.
Yeah, it's being an advisor is a tough job. I actually think advisors deserve a lot more respect than they get sometimes, because it is really, really a tough job. To wrap it up, Alex, I was thinking about, you have such a core, strong investment philosophy, and I don't think you get distracted by a lot of the noise that we tend to get distracted by. But so as you look at the markets today, as you look at ETFs today, in terms of product development, in terms of ways to offer market access, any trends, anything that is catching your eye that you're finding interesting right now?
It's a challenging environment. Let me just start by saying it's a challenging environment because we're currently in a rising interest rate environment. And that is challenging for most assets at the same time. And that's something that's really hard to diversify against. So this started in, January of 2022. We had a little pause in Q4 of last year and maybe the first quarter of this year. And we're tightening again. And it's challenging because all assets compete with cash. And when cash goes from 0 to 5.5, those assets have to go down to offer an attractive return relative to cash going forward. So that's hard to diversify against. So I think, and that's a unique environment. The last time we saw tightening like this was in the early 80s. So call it 40 plus years ago. It doesn't happen very often. And so it's interesting to see trends emerge from that, because as we know, market participants tend to extrapolate, the recent past into the distant future. And I think that's a mistake, because this is not a normal environment, and it can't last very long. You can't have tightening for an extended period of time. So I'm starting to see strategies implemented for this type of environment, and that environment is going to shift at some point, and it's going to probably shift pretty dramatically, like we saw the last time we had a tightening, when Paul Volcker was raising rates dramatically to fight inflation. So I think trends are starting to emerge from that, and I'd be very concerned about following those trends. In general, to me, it feels like we're at a major inflection point. If you look at the last 40 years, we basically, up until January of 2022, we were either in a falling interest rate environment or a zero or near zero interest rate environment. You think of it, you've had this massive tailwind since the inflationary 1970s, massive tailwind supporting assets and markets. It's very possible that we've hit an inflection point. Inflation is maybe higher for longer. Interest rates may be higher for longer. That's a very different environment. And if you think about most investors, their complete experience is that 40-year tailwind. So I'm always thinking about, are we at a major inflection point? And any strategy that is trying to follow a trend and is looking back over the last 40 years, they could be very off in terms of what they're doing. So when I think about all these things, where that takes me is, this is a really good time to be very well diversified. Rather than trying to target what the future looks like, I think it's really hard to guess, particularly if we are at a major inflection point. To me, it's much more important to be well diversified. It kind of goes back to what you said, the things you can control: low fees, low taxes, and diversification. And most people, people are not well diversified. That to me it's like one of the most obvious things, given all the risks we face: potential inflection point, geopolitical risks, inflation risks, growth risks, interest rate risk. There's a lot of risks right now, probably more than I've seen in my career. Looking forward, diversification is the answer to all those things. And portfolios are probably less diversified now than they were 10 years ago. So that's the trend that I'm hoping emerges, that people recognize I need diversification, but I'm not seeing it yet. And maybe it just takes time for that to come out.
Yeah, the school of hard knocks is upon us, most of us. Alex, thank you so much for taking the time to talk today and tell us your story. I'd love to, again, just pitch your books, Balanced Asset Portfolio and Risk Parity, the all-weather portfolio. Anybody who's interested should check it out. Again, appreciate the time, and thanks everyone for joining us today.
My pleasure. Thanks for having me.